Welcome back to our intermediate accounting class. In our last few segments, we've been talking about leases, what they are, why they're important, what questions we have to ask in order to record a lease under GAAP, and how we decide whether a lease is financing or operating for a lessee, sales type or operating for a lessor, and the journal entries that go along with all four categories. We've done a ton of journal entries, and it has been so much fun. Now that we've talked about all of the most common classifications under the new rules, it's time to talk about one other classification that won't be used very often, but you need to be familiar with. And then we need to talk about one of the biggest challenges in lease accounting. And it's actually more of a finance issue than an accounting issue, but we need to be comfortable with it as well. So with that kind of as a preview, let's jump right into what we call short-term leases. As FASB was setting up all of these rules, their goal for the lessee was simple. You're going to have to capitalize your leases. That was the priority. For the lessor, we left it open, and they went back and forth through a lot of different options and finally settled on what we've seen, where sometimes you sell it off and sometimes you just show rent revenue or lease revenue coming in. But there was a group of people that really started fighting with FASB about these options. They're too complex, they're too hard, we shouldn't have to do all of this. Even the operating style of a lessor's lease still requires that capitalization and then amortization of the direct costs, and do we really have to do all of that? It's really very straightforward. Can't we just do what we've always done, a really simple journal entry recording the money coming in or the money going out? And their argument was there are some leases that are so small it's just not worth the effort to go through all of these steps. And FASB finally agreed after quite some time. They did not want to do this. But businesses and others finally prevailed on FASB to say that there are some leases that just aren't worth the effort for these big involved processes. So what we get are what we call short-term leases. And this is a very, very small subcategory, because in order to count as a short-term lease, the lease term has to be for less than 12 months, and there can be absolutely no option to purchase or renew the lease. So what kind of things fall into this category? Well, a really good example is farm machinery that you only need for 2 or 3 months over the summer. Another great example are the leases on apartments that students take out over the school year, because it's only going to be 9 months, and then you have to reapply, and maybe they'll take you back next year, but there's no guarantee. So those are the kind of things that really are going to fall under this umbrella, really small, short leases. If you do fall under this umbrella, the journal entries are really simple. If you don't, then you're going to do all of the involved calculations that we did before. So let's take a look at an example of short-term leases. This is Farview Farms. They need a tractor, but they don't really need it for a long time. So they've contacted Troy Tractors. They want to use their Model SX. Model SX has a 6-year useful life with no salvage value. They'll just get worn out. The cost is $40,000. It's sold for $50,000, but it has a few units that they rent out for $500 per week. The general manager for Farview says, we'd like to try it for 2 weeks. Maybe we'll do a longer lease or buy one after that, but I really just need one for 2 weeks to try it out. So what does the journal entry look like? Well, there's really not much to it. First off, we have to decide, does this qualify? And the answer is yes, because it's only $500 per week for 2 weeks. And there's nothing in the contract that suggests that Troy Tractors will allow Farview to roll into another lease or buy something at a discount. It's just a 2-week trial. Then if you want to buy one, you buy one. That's it. So the journal entry is simple. For Farview Farms, we debit rent expense for $1,000. We credit cash. That's it. For Troy Tractors, we debit cash. We credit rent revenue $1,000. At the end of the year, Troy Tractors would also have to depreciate these rental units, but that's kind of beyond what we're doing because we're only looking at this 2-week window. That's it. And this is what we used to do for all operating leases. Most leases were done this exact same way. And now with the new rules, we won't be able to. But they did leave this one exception, and that's all there is to it. Kind of nice, isn't it, to do something that simple after all the calculations we've gone through. Now, the other thing we need to talk about in this short segment is the challenge of coming up with the value of a lease payment. You see, up to now, I've simply told you the lease payments are going to be $56,825. but the lessor has to figure out that amount. They have to decide what they're going to charge. And again, this is a finance option. The finance team puts this together. But as an accountant, you should be able to calculate this as well, just because, well, we're supposed to be really good with all these numbers. So how do we decide this? Well, the big thing to remember is that the lessor is going to insist on getting the full fair value of their asset. So let's say we have an asset worth $100,000 that we want to lease out to somebody else. I'm going to get that $100,000 somehow. Either I'm going to sell it for $100,000 on the open market, I'm going to use it myself and get $100,000 worth of work or utility out of it, or I'm going to get it from my lessee. So if the lessee wants to keep it, or the lessee wants to use it right up until it's worthless, then I'm going to insist that the value of the payments that I get from my lessee give me back my $100,000. If they're going to give it back to me so that I can sell later, we call that a residual value. And I'll take that out of what the lessee has to pay. So this is what the lease has to cover. And this is what the residual or after lease will give me. And the sum of these two is going to give me that $100,000. And that's the real key to this, is remembering I'm going to get my $100,000 one way or another. This much from the lease, this much as a residual value or after the lease. I can get that residual value from leasing it to somebody else, from giving you another lease, from selling it to somebody else, selling it for scrap metal, selling it to you as the lessee, lots of different ways. But I'm going to get my $100,000 one way or another. So how do we do this? Well, first thing we do is we figure out this after value, the present value of whatever we're going to get at the end. So in this example, let's just say that at the end of 3 years, we think this is going to be worth $2,500. Fair market value. So before I can figure out what I'm going to charge my lessee, I got to figure out, well, it's $2,500 in 3 years. How much is that worth to me today? And we do that by getting the present value of the residual as the residual value times the present value in periods at a given percent. So in this case, our residual value is $2,500. And again, this residual value, it can be the open market value that I think I'm going to get back. In our previous example, we used $100,000. It could be a bargain purchase option. I'm going to sell it to you for $2,500 or $60,000 or whatever it is below market value, but then that's what I anticipate getting. It could be, I think I can release this for a certain amount. It could be anything, but we put it in there as whatever we think we're going to get out of it at the end of the lease period. So let's see. Present value factor, and let's say is 3 years, and let's say 10%. Now if I solve that either using a table or using a financial calculator or Excel, and we've walked through how to do all of those, I end up with a value of $1,878 in today dollars. That $2,500 in 3 years at 10% interest, today that's worth $1,878. So to get the value of my lease payments, I'm going to take the fair market value, that's $100,000. I'm going to subtract the present value of whatever the residual is. So in this case, that's $1,878. So the present value of my lease is going to have to be $98,122. That way, I'm sure I'm going to get $100,000 one way or another. In this case, I'll get some of it in that lump sum payment of $2,500. The rest of it, I'm going to get in lease payments. So what do I do now? Well, I solve for the payments. So the present value of a lease is going to equal the payments times the present value of an annuity due and periods at a given percentage. And now I know all but the payments. I know the present value of the lease is $98,122. I'm looking for the payments. I'm not sure what those are yet. Present value of an annuity due factor, 3 years at 10%. I now solve for my payments. And you can do that a couple of ways. You can take the 98,122 divided by a factor from a present value of an annuity due table. Or you can put it into your calculator. You can put it into Excel. If you put it into Excel, the command is payment, PMT, and make sure you put in a negative sign because all present values come up as negative in Excel. But if we do that, the payment would need to be $35,869 from any of those methods. Give or take a couple bucks. Anytime you're doing present value, you have to be forgiving of rounding. Now, hopefully that makes sense to you because this is a really important idea, being able to calculate the payment value. As a matter of fact, I would say this is one of our key concepts with leases, is being able to figure out, well, what should we charge in order to get our fair value out of this lease? So please make sure you're comfortable with it. And with that in mind, I think we should practice one more time. What I want to do is walk through how we got the value of our payment in our earlier Cisco Hanford example. So let's run through this calculation. The fair value of that asset was $300,000. And Cisco figured they could get $100,000 later on. This is the future value of the residual. So what we want to know is what the payments would have to be. Now we know this number already because we did a lot of journal entries with it, but let's walk through the calculations. So first things first, we need to get the present value of this residual. That's $100,000 times the present value, 4 years, and Cisco used 4%. So if I calculate that, and go and get this 4 and 4%, so 4 years at 4% is 0.85480. So the value of that $100,000 that I'm going to get in 4 years today is $85,480, which means Cisco, if I want to get $300,000 total, I have to get from the lease that's what the lease has to give me. And if I get that much from the lease in the payments at 4% interest, then I'll have made my full $300,000. So let's see, 214, 520. Let's go ahead and get this value. Again, 4 years, 4%, 3.77509. So my payments will be the 214,520 divided by the 3.77509. 56,825, which is the number that we used all through examples 1 and 2. But that's how we calculated that value. Now, some really important ideas in this segment. How do we account for short-term leases that really just aren't worth the effort of those longer-term methods? And how do we come up with that value that we're going to actually charge to our lessee? Really important ideas. Hopefully you're comfortable with them. When we come back, we're going to use these ideas as well as everything else we practiced to do a comprehensive example. So fun calculations and journal entries coming. We'll see you then. Thanks.